Hey everyone, welcome back to Learn-to-Earn. Today we're diving into two powerful emotions that control the stock market: greed and fear. These emotions drive the volatility you see every day in the market, and if you want to navigate the stock market like a pro, you need to understand how they work. Let's get started. Two polar opposites rule the financial markets: greed and fear. They're like two sides of the same coin, passing the scepter back and forth, driving the volatility you see and participate in every single day. Greed can drive prices from mild optimism all the way to full-on euphoria, while fear can send them spiraling into panic. These emotions never go away, and they never run out of fuel. As long as the markets exist, they will keep powering stock price movements. Let's look at how this plays out. Picture this: it's a volatile morning in the stock market, and you're watching stock XYZ. The market opens, and XYZ is priced at $201. By midday, it's jumped to $220. Now, did XYZ's fundamentals change during this time? Probably not. It's likely that greed is pushing those prices up. Investors see the stock climbing, and they decide to buy in, driving demand higher, which pushes the price even further. But what goes up must come down. When the price starts to fall, and it will eventually, fear is what drives the sell-off. Fear of losing money causes investors to panic and sell their shares. This cycle of greed pushing prices up, followed by fear pulling them down, is what creates market volatility. And here's the thing: these emotions aren't always driven by logic, but by perception. They can make you react impulsively, which can be dangerous for your wealth. Take greed, for example. It makes us chase stocks. When a stock is soaring, we want in. We buy at higher and higher prices, hoping to cash in on the momentum. But by the time our order gets filled, the buying frenzy has almost completely dissipated, and the stock begins to fall. That's when greed backfires. On the flip side, fear can be just as damaging. The fear of losing money might push us to sell a winning stock too quickly, locking in smaller gains than we could have had. It can also cause us to hold on to a losing stock for far too long, hoping it'll rebound. In both cases, fear clouds our judgment and prevents us from making rational decisions. So, how do you avoid letting greed and fear control your trading decisions? The key is to replace them with positive emotions like discipline and patience. Start by reading up on market psychology and stock trading strategies. Take time to learn how to read market actions and reactions. Move slowly, study hard, and apply what you've learned in a cool-headed, disciplined way. If you can do this, you'll have an edge over 99% of the market players. Now that you understand how greed and fear drive the market, let's talk about supply and demand. These two forces move world markets from tech stocks to commodities 24/7. Here's the basic idea: we want what we can't have. When a product is scarce, we're willing to pay more for it. But when there's an oversupply, prices fall as sellers try to unload their stock. Greed and fear are the driving forces behind supply and demand. Limited quantities of a product create demand, and as greed kicks in, buyers are willing to pay higher prices to own it. But when an oversupply hits the market, fear sets in, and prices drop as sellers try to unload their stock. Understanding how greed, fear, and supply and demand work together can give you a huge advantage in the stock market. By recognizing these forces and learning to manage your emotions, you can make smarter, more rational investment decisions. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the bell for more market insights. See you in the next one.